All right, let's talk Titan America's Q3 earnings. Now, this one's interesting because on the surface, the numbers looked a little mixed. They actually missed on revenue, but the stock went up. So what gives? What did the market see that a quick glance at the top line might miss? Well, that's exactly what we're going to unpack today. It's a classic story of quality over quantity. Okay, so here's our game plan. We'll kick things off with those headline numbers, the ones that caused a bit of confusion. Then we'll get to the real star of the show, the margin story. After that, we'll look at what's next for the company, their guidance and big strategic plays. And of course, we'll wrap it all up with our take, the next call. Let's jump in. All right, section one. Let's dive right into those headline numbers. This is where we see that interesting tale of two completely different metrics.
So, starting with the good news, right? On the bottom line, profitability. They did great. Adjusted earnings per share came in at about 33 cents. Now, Wall Street was only expecting 31 cents, so that's a nice 2-cent beat. A clear win, no question about it.
Okay, but here's where it gets tricky. The top line, the actual sales number, was a different story. They posted a miss, even if it was a small one. Revenue landed at $436.8 million, which was just a hair under the $439.3 million everyone was forecasting. And there you have it, the central puzzle. On one hand, you've got a fantastic earnings beat. Net income was up almost 45% year over year. That's huge. But on the other hand, you have that revenue miss. So it really begs the question, right? If sales were a little light, why on earth did the stock go up?
Well, the answer, my friends, is all in the margins. This is where we need to look under the hood to see the real story, the incredible strength that the market was reacting to.
And here it is. This chart right here is the whole ball game. Look at that jump in adjusted EBITDA margin. We're talking a 270 basis point expansion. It went from 24% all the way up to 26.7% in just 1 year. That's not just a minor tweak. That is a massive leap in profitability and a huge signal about how well this company is being run. This is the heart of the bull case, right here. So how did they pull this off? Well, management laid it out pretty clearly. It was a mix of things. They got smarter about their sales mix, basically focusing on the higher margin products. They were super disciplined about keeping costs in check, and they made their whole logistics operation way more efficient. They even managed to fight off pressures from things like labor costs and tariffs. It just shows they're executing their game plan almost perfectly. And get this, they achieved all this incredible profit growth without loading up on debt. Their net leverage ratio is just 0.71 times. That is incredibly healthy. It basically means their balance sheet is rock solid, which gives them a ton of flexibility to invest and grow down the road. It's just really impressive financial discipline. Okay, so that's the story of Q3. But what about the future? Let's turn to what management is saying about what's coming up and the big strategic moves they're making. Now, management was pretty upfront. They did trim their full-year revenue growth forecast just a little bit, down to a new range of 2 to 3%. And they gave some good reasons why, pointing to some bad weather earlier in the year and the fact that the residential housing market has been a bit soft. So it's a cautious but realistic adjustment. But, and this is a big but, despite that little trim for the short term, the CEO, Bill Zeralis, was super confident about the long-term picture. He basically said, hey, look at the powerful trends we're riding. He's talking about massive tailwinds like modernizing our infrastructure, the boom in data center construction, and bringing manufacturing back to the U.S. These are huge multi-year trends that they are perfectly positioned to benefit from. And their plan to capitalize on all this is really clear. It's a three-pronged attack. First, they're getting into new, more profitable products like precast lintels, those key structural beams you see in buildings. Second, they're squeezing more efficiency out of their existing operations, like their huge aggregates plant. And third, they're fixing their pricing power, with price increases set to roll out at the start of next year. It's a really solid strategy for driving margins even higher.
So, after digging through all of that, what's the verdict? What's our take on Titan America from here? This is the next call.
All right, so here's the big question on every investor's mind. After a quarter where the market basically said, we care more about profits than just sales, where does the stock go from here? What should we expect? Here's our forecast. Looking ahead to Q4, we actually see revenue growth picking up steam, accelerating into that 4 to 6% range. Why? Well, they'll be up against an easier comparison from last year's weather, and those price hikes will start to kick in. We think margins will stay really strong, probably around 25.5%. A little off the Q3 peak, sure, but that's just normal seasonality. Put it all together, and our 12-month price outlook lands somewhere between $1,650 and $17 a month.
So our final call is this. We are initiating coverage with an outperform rating. We think the market has this one right. They're looking past the tiny revenue miss and focusing on what really matters, the incredible structural improvements in their profitability and that rock-solid balance sheet. At the end of the day, the quality of these earnings just completely outweighs the quantity of that small sales miss.
And of course, before we wrap up, the important disclaimer.
This is not financial advice.